On today's Hashi, I'm discussing housing inventory, empty nesters in large homes, and home price predictions for the most accurate forecaster from 2023. Today is Tuesday, January 16th, 2024. I am Byron Lazine, and the hot sheet starts now. All right, lots to unpack. We've got that empty nester study from Redfin, which I just found fascinating. And we heard from the CEO who was the most accurate on price projections for 2023, while many were wrong. So we certainly want to take his outlook for 2024 into consideration. And we are going to check that out. Let me know which market you are tuning in from. I am in my Naples, Florida studio. And as we do to kick off every week, let's jump into inventory levels and take a look at how maybe this spring market is already shaping up to be a good one, or maybe a standard one, we should say. Number of price drops is dropping, but we'll get to that in a minute. First, let's just take a look at the overall inventory levels. And the weekly inventory change for the last week, January 5th to the 12th, did rise from just under 500,000 to over 505,000. Last year, we saw an increase in inventory during the same week, but it was a smaller increase and a smaller overall number. Last year, during the same week, we saw inventory levels rise from 471,000 plus to 473,000 plus. So year over year being at 505 to 473, that's better. Plus the overall increase was greater. The inventory peak for 2023 was 569. So if we have a small or a strong beginning of the year here, we could potentially even pass that somewhere in the first half. If we take a look at 2019, all right, because that's going to be a pretty normal year, pretty normal indicator of where we want to end up right now, or at least get back to 2019, this time frame. Let's take a look here. 2019, January 11th, we were at 813,000. So we're still a long way away from that, sitting at the 505 marker. Okay. If we just look at the beginning of 2020, because January of 2020 would have been much different than middle of 2020, we were at 733,000. Okay. Just so those numbers there, you kind of average that out. You might be I don't know, 775. We're still obviously well off of that mark here at the 505 level, but again, above last year. So things are improving in active inventory. Active inventory, according to Altos Research via Housing Wire, does not include pending sales like NAR, National Association of Realtors, numbers, which do. Let's take a look at the price cut. A typical year, a third of homes will do a price cut before they actually sell. Just a normal year. Okay. The price cut percentage right now is 32.2% of homes. So pretty much normal and below where we were this time last year at 35.8%. Of course, 2022, beginning of the year, you had an interest rate that was sub 4%, and you see there 21.7%. If we go back to 2019, because we like to look at that time frame as being fairly normal in consideration to where we are today, you had 28.7%. So pretty close there, 32.2% to the 28.7 in 2019, or 29.2, I'm sorry, in 2019, same week. So we're about 3 points off exactly from 2019 in the same week, and we are declining. So price cuts are actively getting better here as we start the year, as is new listing data. This can have a huge impact on active listings if we can continue to take new sellers onto the market. Of course, they often become buyers, which absorbs inventory on the other side. We'll get into some empty nester stats, though, on maybe how we could get more inventory without somebody going and buying a house that kind of replaces that one off the market. 39,640 new listings for the last week. That's better than the same week in 2023 and in 2022 for new listing data. So starting the year getting more listings than we've seen in the last couple of years, and we'll obviously see how that continues to move. Just one last note here about the active listings. I'm going to go back to that really quick. You'll see here that if we track last year, same week, again at that 472,000 level, we kind of flattened right there. See this? We kind of flattened, and then we continued to drop all the way till we bottomed out in April. Be interested to see what we do here next week. If we have one of these flat little bumps mid-January and start following that same trend line where we drop into the spring, or could we potentially maybe add inventory into the spring? I mean, that'd be really best case scenario. You're adding inventory into the spring market, or at least maybe flatlining. Probably not likely, but I'm definitely gonna root for it. If you look at 2019, that's what happened. Okay, so 2019 inventory was increasing all through the spring, then leveled off in the summer, then had that seasonal decline at the end of the year. But really, from this point till about March in 2019, inventory levels were flat, just hanging around the 800,000 number. And then middle of March, they accelerated up till they topped out at 966,000. Could we see a trend line like this? That would impact affordability considerably if we could get that level of inventory onto the market. It would lend to a much healthier market and deal flow going into this spring market, and it would definitely feel more standard. We're still sub 4 months of inventory across the country, which is a seller's market, of course. Anything under 6. Okay, Redfin did a report on empty nesters. We've talked a lot about this potential silver tsunami theme that's out there, where you have a lot of baby boomers owning a lot of property. But what specific property do they own? Empty nesters own twice as many large homes as millennials with kids. So maybe there's even more of an opportunity for this inventory to loosen up and come onto the market. Empty nest baby boomers own 28% of the nation's large homes, while millennial kids just own 14%. Millennials with kids, that is. You see the baby boomers there at 28%. 3 or more kids for millennials in the red, and 1 or 2 people. So 1 or 2 people, no minor children, would be that that empty nester category. So 3 or more people, no minor children, is the red category. So my apologies there. So if you go all the way to the right, baby boomers, you see 28% are empty nesters. Then you've got 3 or more people with no minor children. That's up over, when you include that category, it's up over 35%. And then a very small portion of adults living with their kids to top off there, of baby boomers owning a total of over 35% of large homes in America. Gen X now, you've got empty nesters and Gen X making about 11% of large homes. 3 or more people with no minor children gets it up to almost 20% when you add the 2 categories together. And then adults living with their kids, then you're up over 32%. Millennials, 14%. With kids owning these large homes. Gen Z, not a relevant number yet. We'll see what happens there over the next 10 years. Okay, so this is based on Redfin analysis of U.S. Census data from 2022, which is the most recent year that data is available. Breaks down the share of 3-bedroom homes owned and occupied by each generation, this household type and size. And there's some more fascinating stuff here. One, Redfin states that there's not much financial incentive to let go of the large homes. Okay, so 54% of the boomers who own these homes or own homes have no mortgage. Okay, 54% of boomers who own homes have no mortgage. They just own them free and clear. So financially, to let the bigger home go, there's not pressure financially. I don't know if I would say what Redfin is saying is right, where there's not an incentive, because the incentive would be, it's like, your roof's 25 years old, your AC needs to be repaired, you haven't done anything about the furnace, you still got, 1999 2000 finishes rocking in that kitchen, and people don't necessarily want that. So financially, you either got to put a bunch of money into the house or move on from it at the top of the market now when there's low inventory, and don't have to worry about all that stuff. Maybe go into a nice new brand new townhouse, something that's walkable, something like that. Flip that money into that. So I would say that while they don't have financial pressure, the incentive would be to get out ahead of those problems, right? Like those problems in another 5, 10 years of just living in the big house because you don't want to, organize your photo bins, means that you're going to be paying significantly even more to repair the home, to get the home ready. And maybe you're in a less competitive market. Maybe some of those analysts are right, and there's a silver tsunami in 5 or 10 years. And you're trying to sell off during the silver tsunami, and you've got all these, you know, maintenance issues. How many know baby boomers that just because their house was they bought it brand new in 2000, they still think of it as brand new. There's a lot of people that do that. They're like, wow, everything's new here. Dude, you bought the house 24 years ago. Okay. It's not brand new anymore. It's brand new when you bought it. When you live in something, sometimes you just think things are updated still. Okay. And there's a lot of folks, I mean, agents know there's a lot of people that believe that. They can't see it because they live it, they're comfortable with it, they know it. And if things aren't broken, they don't think there's anything wrong. But when you're on your last 6 years of lifespan on these issues in the home, they can add up. They can get very costly. So that's where I think the incentive is. And I think the opportunity for agents lies there. If you've got 28% of boomers owning large homes, empty nester boomers owning these large homes, and only 14% of millennials with kids owning these large homes, there's an opportunity to match make there. There's an opportunity to get one generation to get ahead of maybe a silver tsunami, or get ahead of a different type of market, and get that home into the millennial generation where they have a need for it. Okay. For millennials and Gen Zers, it's harder to find and afford a home. So that's where the opportunity is for agents. Large homes are in short supply, obviously because of the rate lock, and the lack of home building over the last 10 plus years. They're also harder to afford a larger home for a variety of reasons. Insurance is up, everything else is up. Okay. Let's go and I'll take a look here at our show notes really quick, which are available for all of our BAMX members. We upload this every single day. Use code HOT to get 10% off of BAMX if you're not in already. 10 years ago, young families were just as likely as empty nesters to own large homes. Not the case anymore. Affordability was better for boomers when they were young. So the financial incentive right now, again, is low. That is so true. Affordability for boomers was definitely better years ago. It also they've had an easier time wealth building with the 401k over the years. There's just no question about it when you compare it to really what the millennials have, what hand the millennials have been dealt over the last 10, 20 years in this in the country and the economics. Millennials make up, though, roughly 28% of the country's population. It's the largest share of any generation now. Despite this, they own half as many homes or as large homes as those empty nesters. Baby boomers, and this is the big one. This is the one I've been really trying to help agents understand, is because this is the opportunity. You want to create relationships in your community, create them with the baby boomers. Okay. That's your path there for listings over the next 5, 10, 15 years. Baby boomers own half of the wealth in this country, in the US. It's also 1/7 of the world's wealth. Okay. And much of it is made up in real estate. Okay. So baby boomers' wealth right now is high because real estate's high. And the opportunity to help baby boomers understand that, especially those 28% that are in those large homes, empty nesting, to take that, get it into something that's at that downtown walkable, the smaller suburbs, the newer product, smaller square footage, that is probably going to hold and appreciate with less maintenance required over the span of the time that they're going to want to enjoy it versus the large home, which is just more maintenance, more tax, more insurance. That process of educating boomers on that is such a big game right now. And the really smart listing agents are going and attacking that. Many young families right now are also renting large homes as an alternative to going out and buying one of these. Millennials with kids take up the largest share, 24.8% of 3-bedroom plus rentals in the US. Okay. So when you're data mining, maybe a prop stream, we have a link with an opportunity for everybody for prop stream at the bottom of all our videos. Prop stream's a great data mining company. Maybe you go and data mine those millennials looking at 3+ bedroom homes and match them with the boomers who own these large empty nesters so that you can be that deal maker. Don't rely on Zillow alerts to help your clients find homes. This is the kind of things that the great agents are certainly doing right now. Empty nesters take up varying shares of large homes in different metros. Actually, I'll go back to the original piece here on Redfin, and I'll just go through the table here with you. If you've got a market, be happy to just type it into the comments, and I'll take a look at that. Atlanta, 25.5% for empty nesters, share of large homes by empty nesters, while millennials with kids owning large homes is only 13.8. Austin is 22 to 15.5 spread. You've got Baltimore 27.5 to 13.3% spread. Big spread in Baltimore. Let's take a look. Boston is 25 to 12.5. That's a big spread. Buffalo, 30.5% to 14.1. Congratulations to the Bills fans out there. Cincinnati, 28.6 to 17% spread. Charlotte, look at that, because Charlotte's got inventory issues and huge amount of investment coming into Charlotte. You've got a big spread there, 26.5 to 13.5. So there's the opportunity that I'll be looking at in a Charlotte. Jacksonville's got a big spread, 30 to 14.5. Louisville's got a big spread, 29 to 16. Memphis, big spread with 29.4 to 14.1. And you've got New Orleans, 28 to 14. Pittsburgh, real big spread in Pittsburgh, 32 to 12.7. Okay, so your metro's probably on there. This will be linked up for the BAMX members to go and grab there. If you'd like to take a further look at the empty nester study, I'd see how that can work and fit into your marketing plans and your calls for 2024, especially if you're an agent or an investor. It's a huge investment play there as well. Okay. Lastly, Nick Shaw. He is CEO of Home.LLC. Nick Shaw put his forecast out at the beginning of 2023 based on his model, based on his outlook and his research and study. Okay. And as did other analysts in real estate, many of them wrong. A lot of them, remember, had home prices even dropping for 2023. We know now that didn't happen, but Nick Shaw knew that before the year happened because that was his projection. Back in November of 2022, he told Lance Lambert, then of Fortune, now of Resi Club, that analysts at his firm were forecasting the national home prices would rise to 4% or with a bull case of 6%. And they were right. So Lance said, I got to have this guy back on. I got to have him ask him some questions here um, to let us know, where is this number going from here? Here's what's happened since 91. Average year over year reading since 1990 is 4.4%. But where are we going from here? Obviously, we had huge price growth deceleration after the mortgage rate increase, as you see all the way to the right, only to bounce off of that and continue to go up last year. All right. So, what are some of the data and some of the questions here? Talking about months of supply. Okay. Months of supply have risen since the pandemic lows in 21, but we're still below 4 months, as I mentioned earlier in the show. Do you think mortgage rate shock? Why do you think that the mortgage rate shock didn't translate into a greater uptick in listings? It's got three reasons. Mortgage rate shock didn't translate into increased supply because there's only three sources of supply, and they're all constrained right now. So Nick Shaw, three sources of supply, they're all constrained. Existing homeowners, okay, obviously they were locked into their rates. So that's why we had that lock in with existing owners. New construction, okay, while we were building for 10 years, we weren't building a lot. And they offered many incentives to make sure that their products sold. Okay. So there wasn't a lot of supply there as they were offering incentives. People were flocking into those new homes. And you saw that rise in new home sales over the year. And then you've got delinquencies as the third area to increase supply of listings. And delinquencies did not translate into foreclosures in 2023. It just didn't happen because if you're in a position where you're going to be delinquent or you are delinquent, you sell the house because you've got tons of equity. Okay. So U.S. home prices, let's look at his forecast for 2024 because that is what we're interested in, because he was one of the few that were right in 2023. So hedging the bet here, bearing a black swan event, we predict that the housing market will appreciate even more. They're projecting now a 4 to 7% increase in the Case-Shiller Home Price Index, and they believe that mortgage rates will increase demand. Their AI models project a 5 million increase in home buyers for every 1% drop in rates. Okay, that might be a number to remember. Okay, if you're trying, if somebody's like, maybe I'm going to wait, maybe I'm going to wait till the rates drop. And you could, a lot of us say, hey, if you wait for the rates to drop, do you think there's gonna be more or less competition? It's a great question to ask. You could now back that up by saying there are models right now that are projecting, and this one model in particular from Home.LLC is from analysts that were one of the handful that got the price increase right in 2023. Their model projects a 5 million increase in home buyers across the country for every 1% drop in interest rate. Even if it isn't 5 million, I think it's safe to say that we can all agree that home prices are going to potentially go up with more demand as rates go down. All right. So in contrast, there are less than 1.5 million homes listed for sale. So as you see, supply and demand dynamics, these rates go up, or I'm sorry, these rates go down, and 5 million new buyers come into the market, and we don't get supply from somewhere. There's going to be a lot of pressure on home prices to go up again. Housing supply will remain lower than demand. For resales, AI projects decreasing rates will increase demand way more than increasing supply. Plus, there's an 11% annual drop in construction of single-family homes. Increasing unemployment won't materially increase delinquencies because the credit quality and home equity of most borrowers is pristine. We covered that last week, where we're just in such a different situation. Here's some of the they're bullish nationally, but they're bearish about Austin, Boise, and Denver, and they have been since 22. If they have been since 22, they've obviously been right in those markets. Affordability, another comment here. Affordability might improve, but won't be fixed. I think we can all see that. A significant change in zoning is unlikely. We've talked about this a whole bunch on the hot sheet. Nick Shaw, very interesting CEO. And I think we'll be reaching out to him for a Knowledge Brokers pod just to have a conversation with him. Of course, if you missed last week's Knowledge Brokers pod, Tom and Lisa chatted with Danielle Hale, chief economist from Realtor.com. Make sure you go to @Knowledge Brokers podcast on YouTube or wherever you listen to check out that conversation. Let's check out the 10-year yield. And we are just below 4%, kind of bouncing above 4 and then under 4 right now. 3.99. We'll take a 3 as opposed to a 4. As we ended the week last week on the 30-year fix, we ended at 6.69. We'll see where we go today. We've been really close to that 6.7, 6.75 range here quite some while. I thought this was also interesting here today on CNBC. IMF says that the U.S. economy has already seen a 75% impact from the Fed's hikes, and so that they're projecting that soft landing that we're all rooting for. We'll obviously be monitoring that closely. We've got a bunch of data coming out this week, and I'm sure the market will be watching, as they always are. Dow right now down 240 points, S&P down 0.5%, NASDAQ down 0.5% to start the week. So 10-year popping up over 4 and then back under 4, and stocks down here to start after the 3-day holiday. Hope everybody has a great start to their week. If you want to get the most out of what we're doing at BAM, make sure you jump into BAMX. You can use code HOT to get 10% off of that. You get all of our show notes, our daily downloads, our monthly courses, live streams, and our great community over at BAMX. When you sign up, get 10% off by using the link down below. And if you haven't done it already, grab your free seat for our virtual event on February 7th. It's the BAM Pro Bowl. It's going to be headlined by Ryan Serhant, Neil Dingra, David Childers, Jason Pantana, Gary Gold, Danielle Garofalo, Marie Lee, Jimmy Mackin, as well as myself, Eric the Broke Agent, actually agents. We even have an anthem by Amanda Bradford, halftime show. It's going to be one of the best virtual events you've ever attended. That's going to be on February 7th, Super Bowl week. It's a totally free event. We've got the link for that down below. All right. Have a great day. And until today, 2:00, we'll be posting the Real Word podcast here on this channel. So subscribe. Until then, I'll see you in the comments. And of course, toodaloo.